Hello, everyone, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day, and although the VRIC is over for 2023, we are keeping things rolling with great guests and interviews for you every Friday. The next VRIC is also coming up January 21st and 22nd, 2024 at the Vancouver Convention Center. And today's guest is a daily columnist at Kitco News and the executive producer of the Gold Forecast, a video newsletter for traders and investors. Mr. Gary Wagner, it's great to have you on.
It's an honor to be with you today. Thank you.
Well, it's our honor as well. And I want to get started with the big financial news that's been happening this week. It seems the world is in chaos, at least if you're on Twitter or FinTwit at the moment. It's the collapse of the Silicon Valley Bank and Signature Bank. Now we're seeing Credit Suisse running into problems. People are speculating that a contagion could be spreading throughout the banking sector. And perhaps this is a sign that there's weakness there that people were not anticipating. So I wanted to ask you, give me your opinion on what is at the root cause of these banks collapsing and the issues with Credit Suisse, and is there more of this to come?
Well, that's a complicated question in two parts. But to answer your question, there was a run on in terms of depositors attempting to get cash out of Silicon Valley Bank. The real question is, why is that? I believe that the banks in question, New York Signature as well as Silicon Valley, are unique. Even though Silicon Valley was the 16th largest bank in the country, its clientele base was unique and different from a lot of the other big banks, which we'll address if I think there'll be contagion. But when the pandemic hit and interest rates were at near zero, they took their assets and put them into mortgage-backed securities. They also put them into tech-heavy stock equities. And then lastly, into Treasury and US debt instrument yields, which at the time had extremely low yield. Then the Federal Reserve came in and started hiking up interest rates. And of course, when interest goes up, the value of bonds go down. There's an inverse relationship between a yield and the price of the bond. So their portfolio basically shrunk every time the Federal Reserve raised rates. And so what happened is they saw they had a liquidity problem, and kind of the straw that broke the camel's back was that as they saw this run, they went and liquidated part of their equity portfolio and took a hit. I believe it was reported of $1.8 billion. That kind of set a domino effect of depositors wanting to make sure that their money was still solvent. And that's when we saw the run on the bank. The FDIC stepped in, the Treasury Department, of course, Biden even came on. And what I think is unique about the government approach to the solvency of this bank and kind of making sure that depositors got their money is in the 2008 bank out, they supported the banks and the stockholders and the officers, making sure that they put money in, making sure the bank didn't go under. In this case, they guaranteed the money is available to the depositors, and they're not protecting the stockholders or the officers, which I believe is a very, very eloquent and best solution for the problem, because they're the ones you want to worry about, not the officers. Not that you shouldn't worry, but they're making sure that the depositors get their money. They also stretched the limit. The FDIC limit is $250,000, and they came out and said, even if it's over that, we're going to still make sure your money is there. And that's basically the way I see it, what happened.
So do you think this could, how do you feel about Credit Suisse and what's happening there? And do you think this could create a situation where we start to see more of these banks fail, or is this situation unique to Signature Valley Bank, Silicon Valley Bank and Signature?
I think in a lot of ways it is unique, and it's based upon the portfolio of who they lend money to. Silicon Bank was best known as funding venture capitalists, new tech startup companies. They're in Silicon Valley, and their base of people that came to them for money were new ventures. And so that has an intrinsic risk to it. And of course, when we saw a softening in some of the tech stocks earlier this year, it took the values down. If you look at some of the other major banks, they have a much more diversified portfolio in terms of their clients that are acquiring funds from them, as well as where they're putting their assets. And for that reason, I don't think we're going to see a contagion. I don't think we're going to witness the same kind of travesty or meltdown in the banking system that we saw in 2008, because that was based on other issues, which was not having enough funds on hand, a lack of liquidity across the board. That's when the regulators tightened and made steps. The Federal Reserve does a stress test on all these banks each year. And so the banks are much more capitalized in a way that should keep solvency to a minimum in terms of it spreading across the board. My sense is we might see a couple more, but I don't think we'll see a contagion effect in which it spreads across the board, because there are unique circumstances that the banks in question had difficulties.
Well, that was a great breakdown of the situation. Thank you for that. And speaking of the Fed and raising rates, we've seen a shift from near zero interest rates, as you were alluding to earlier, with a lot of valuations that were disconnected from reality in the stock market as a result, with the tech sector in particular being a big beneficiary. So now we've seen massive corrections in many of these tech stocks and the broader market. The Fed's raised rates at an extremely rapid pace, which is causing quite a lot of pain. Do you think there's more downside to come in the broader market from here on out?
Well, I think the basic question about the Fed is at the root of all of the evil, all of the problems. The topic that I spoke about at the last two VRICs, 22 and 23, was the fact that the Federal Reserve made an extreme blunder. And the blunder that they made is they assumed that inflation was transitory. We know that the supply chain bottlenecks, which were one of the primary issues, was something that would get worked through time, but they assumed that it was transitory. And as they did that in 2022, at the beginning of the year, inflation levels were at 0.36%. And by March or so of that year, they had jumped up as high as about 2.6%, and the Fed did nothing. It's over their target, but slightly. But because they assumed that inflation would be transitory, it would kind of fix itself as these things worked out of the system, they watched it go to 4%, 5%, and 6%, and they did nothing. In fact, their first rate hike occurred in March 2022, and core inflation was at 8.5%. And they raised it by 1/4%. That's when they started this whole thing of each and every FOMC meeting. They went 25, I believe, then 50, 475s, ended up in December with a 50 basis point hike. And then, of course, January, 25%. And then they announced it's going to last longer, because when they released the dot plot back in December, they showed that do not expect any interest rate cuts, or what we call a pivot from a hawkish to an accommodative monetary policy. They emphatically said, don't expect that to happen. And there was a disbelief amongst investors that they were either playing chicken, that this was a bluff, and that it was unsustainable. And yet the Federal Reserve stayed the course. What I'm trying to say is that the big mistake was not raising rates early enough, because had they addressed this in 2021, when inflation was at 3% or 4% with half-point rate hikes, even taking it to 2%, it sat at zero throughout an entire year where inflation ran to a 40-year high. And had they taken steps a year earlier, first of all, I don't think that we would be dealing with the issues we are now. And so what they did in March was, when they pulled the trigger and raised rates by 1/4%, they were being reactive and not proactive. And so they were trying to play catch up from the terrible mistake, the terrible blunder they still haven't kind of manned up to, so to speak. And by assuming it was transitory, and by being wrong on that assumption and waiting for it to wean out of the system, they let inflation run too hot. By the time they did something about it, they had to do too much too soon, and that ran a lot of things amok. Look at mortgages in the banking system, which is a big component right now of what we're dealing with the banks. The CPI came out at 6% headline inflation yesterday, down from about 6.4, has been steadily coming down. I think it peaked at around 9.5%. So we have seen it come down. But as some analysts believe, including myself, there are components of the inflationary pressures that are going to remain sticky. And by nature, they have to. And what I mean by that is, if they keep raising rates, there are going to be issues with people qualifying for mortgages. If the cost of mortgages go up, you're going to have a tremendous contraction in new housing, home sales, and the rental market. And that area, housing, meaning rental and purchases, accounts for about 70% of the CPI. And so it's going to be difficult to have a significant reduction of that component, and the fact that that component is such a overall huge part of what they're looking at, it's going to be a heck of a fight to try to get a handle on that. And the other thing that we have to acknowledge is they have said they're going to slow the pace down. And we saw that with the 0.25% rate hike, but they've also said that expect these elevated rates to remain there longer, meaning they're not anticipating a rate reduction throughout the entire year. And according to the dot plot, of course, that will change when we see what happens in March, about Q1 or Q2 of the following year, 2023. So the problem is clearly that the Federal Reserve didn't act soon enough. The problem of these aggressive rate hikes is a reactive reaction to that blunder. And it is necessary now because you can't let inflation get entrenched. And the only way to do that is to contract the economy to bring inflation down. And what is the definition of a recession? It's an economic contraction of GDP 2 consecutive quarters. And so by virtue of what they're doing, there is really only one outcome, and it isn't what the Fed calls a soft landing. A soft landing, I think, is virtually impossible. My opinion is it's not if we will have a recession, it's how deep and how long lasting that recession is going to be.
Well, you mentioned the market playing chicken with the Fed there, and it seems that they never believe Powell when he takes the hawkish stance and says that he's going to keep raising rates. Why do you think that disconnect occurs? Is it because of that era of low interest rates and easy money where everything just went up? And what do you see their next steps being? Because some are speculating that they're going to pause or perhaps even pivot further this year due to this banking situation. So, where do you see that headed?
Well, I think that what the Federal Reserve will do is they will pause. They've already announced that they have to pause. And the primary reason that that is necessary is there's at least a 2-month lag between implementing a rate hike and seeing what the net effect in the economy is. So if you have these consistent rate hikes, they've done a total of 8. It was every single FOMC meeting from March up until now. It's expected that they're going to do another rate hike. Now the odds are 25 basis points. 2 days ago, it went up to about 81% of 0.5%, but that quickly went down. And actually, when you look at the CME's FedWatch tool, which is a good indicator of what the Federal Reserve might do, there is actually a 18% probability of a 0 rate hike. In other words, actually taking that pause. I don't think that that's likely. A pause is not necessarily a sign that they're going to pivot. To the first part of your question, why do I think the public disagreed with it, is realize whenever we invest in a market, be it equities, gold, housing, real estate, we are not investing for the value today. We're investing as to what we believe will be the value 6 months down the road. And so it was an over-optimistic view that this issue would either get solved, that the Fed will back off, even though they were adamant about saying they wouldn't. It was over-optimism because of that long period of free money. And they simply put, didn't believe it. If you think about it, the first, what I call the hardcore jarring announcement was at Jackson Hole in August, last August. And that's when Powell emphatically stated there will be pain. And you can look forward to a year of hardship and elevated rates. And he made it crystal clear. He didn't mince words. He didn't leave anything or any ambiguity to any of his statements. And yet people acted like disbelief. They acted as though he's saying one thing, but they're really going to do this. They continued to come out with a hawkish doctrine. Even the more dovish Fed members said, we still have a ways to go. The hawkish ones were even hardcore ones, such as Daly, were saying we've got to go back to 0.5%, maybe 0.75%. We've got to get a handle on this. But unanimously, they agreed not to cut rates in 2023. Do I think we'll see a pivot in 2023 from rate hikes to rate reductions? My answer is I don't believe so. I could be wrong, but I don't believe that they will, because they are so singularly focused on not letting inflation get entrenched that they're not going to let their foot off the rate hike gas pedal, so to speak, until they have solid data confirming that they're on the path to 2%, which brings me to another interesting point. Is 2% actually a realistic target for the Fed to have for a level of inflation? My sense is that 3% will become the new 2%. I think that if they got it to 3.5 or 3, they should be satisfied, but that's not up to me. I'm not a decision maker, but I think 2% is unrealistic given the sticky nature of certain components within the inflationary scenario itself. So will they cut rates? I don't believe they will this year. Will they keep them elevated? I do believe that they will. And that's my belief.
So if we're looking at continued rate hikes, perhaps a pause, but perhaps no pivot, as you're alluding to there here in 2023, what does that mean for the price of gold?
Gold is fighting a battle in which two opposing forces move sentiment one way or the other. Inflation rising is absolutely one of the most bullish tailwinds that you can have for market sentiment to shift it from bearish to bullish. And rising interest rates is probably one of the most bearish influences on gold, because gold isn't an instrument. Gold doesn't bear any interest rates. It doesn't yield anything. It doesn't produce a dividend like a stock. So you've got these opposing forces. As rates got ratcheted up, we saw gold go into a multi-month correction from last year's high, which was $10 shy of the all-time high, I think 2,078, and it went down to approximately $1,620 beginning in September, October, and November. It was a triple bottom that we had. And then there was a shift, and the shift started with that optimistic sentiment that you talked about on investors think, okay, they're going to pivot, they're going to do a rate reduction, they're going to stop raising rates, and they started driving the market up. And that's what took gold from 1,600 to current pricing, which is above 1,900. The reality is no one knows what the Fed will do, but if analysts and economists such as myself believe that there is a sticky component, a persistent component to inflation that will be extremely difficult to address and alleviate, then those components are going to be with us for much longer than anyone anticipates. And as long as they raise rates, there will be an exacerbated amount of pressure being placed on the housing industry and mortgages, because it's directly tied to prime, and prime is tied to the Fed's funds rate. So if they keep it elevated, it takes a large component of middle-class Americans who are looking for that first home to be qualified. Those that have excellent credit and have some money, they'll get qualified, but for much less in terms of the overall price of the property. And real estate, although it is cooled somewhat, it is not crashed. It's still relatively high when you look at it over time. So that's a quagmire that I don't know the answer to. And quite frankly, I think the Federal Reserve doesn't have a clear-cut answer to either. So back to affecting gold, when the public focuses on rising rates, we see a tremendous sell-off on gold. When the focus is readdressed and looks at inflation remaining hot and persistent, then the forward-looking investor is looking at gold as a good value because it does tend to keep up with inflation. It is not 100% correlation month to month. It's a very slow correlation over time, but there is a correlation between the buying power of a dollar and the buying power of gold and the level of inflation.
Do you think we're going to start to see more of a sentiment shift in the gold market from, let's say, your average investor? After all of this madness we've had with near zero interest rates, with the crypto sector melting down, now with these banks in danger, do you think people are going to start to look more to physical gold as a safe haven asset, including potentially institutional in investors such as pension funds?
Absolutely. In 2022, the World Gold Council announced that central banks had been on a frenzy to acquire gold, physical gold, as part of their assets at a pace not seen, I believe, since 1967. An immense amount by the central banks. Now, they're the largest players with the biggest pockets and the deepest wells to kind of allocate capital to. I have always believed that all investors, big or small, should have a component, a percentage of their overall diversified portfolio in physical gold. And I've always believed it's anywhere between 5 and 15%, 10 kind of being the sweet spot. I've been in the financial field for going almost 40 years now, and I believe that from day one to today, that it is a safety net of sorts. It is something that you want on a rainy day when everything else is kind of getting devalued, and it has stability in that there is an intrinsic value to gold that has been around for thousands of years, and I believe will continue to have intrinsic value 100, 300 years in the future. I don't see that changing. There's a reason that the first currencies were minted in gold. There's a reason that banking systems, central banks, I should say, by various governments, use gold as their original tokens. Before we had that shift in economic philosophy where if you didn't have it in your treasury, you didn't spend it. And we went off the gold standard. It is, as I see it, an experiment. We don't know how this experiment will resolve itself when you continually print money and make fiat currencies worth less. And it's not that just the United States is doing it. There has been a worldwide race to zero, I should say, in terms of what they're doing with their currencies, because if they need to allocate more funds, they just get into more debt by printing more currency. And what is going to be the outcome of that long term? I don't think anyone knows for sure, because thousands of years, what countries would do is they would only use what they had in their treasury, and when they needed more, this is the bad news, they simply raided their neighbors and took all of their goods and services and then used that as their treasury money. They were robbed from other countries. We're a lot more civilized now, so we don't do that. Instead, we let our national debt go to 31 trillion and then reach the cap. And then there'll be this huge debate about raising the debt ceiling in about a month, because that's slowly approaching us. I believe it's June or July where that has to be dealt with. And so it is an uncertainty in terms of what this great experiment will lead us to, where there is no restraints on the amount of currency a government can print and how much debt they can have. Because every currency we have, rather than saying a gold certificate backed by gold, you can turn this into the bank for a gold coin, it says based on the faith of this government. If you believe in this government, know that we're going to make good this note. And that's why the dollar has been the go-to currency of the world, is because we've never gone back on any of our debts. So to not make an interest payments on our debt, and our debt is huge, 31 trillion plus, would be a catastrophe. And that's also why some countries are looking for ways to tie gold to their currency again. China has that in mind, and Russia has that in mind. And so the outcome is an unknown, because it's really, if you consider that it really broke apart starting at Bretton Woods when they decoupled the dollar from gold. And it started before that in 33 when Roosevelt took all of the gold from every American, melted it down, put it in Fort Knox, and basically doubled the size of our treasury and did some good with it. I mean, that's how the Depression ended, and how all of the main interstate highways and the bridges and all of the infrastructure was built, but to outlaw that you could buy gold. And then Nixon put that final nail in the coffin and said, look, there's no tangible correlation between our dollars and gold. You can't turn it in for gold. Just believe in us. And so you've got since 1976 to now, which is under 100 years, 50, 60 years, where it's never been done this way. So there's nothing we can go to historically to say, well, when they did this, this happened. There are examples of overprinting currency by the Chinese, and that government collapsed. In fact, many of the democratic or even non-democratic countries have not lasted more than 200 years, and almost all of them collapsed because they devalued their currency somehow. And in the days when they were gold coins, they put less gold in them. And that was the number one reason for countries collapsing back then. So that's the only thing that we have as a marker for what happens if you do this with a disregard to tying a currency to some tangible asset.
Well, thank you so much for joining us today, Gary. That was so much insight shared. We really appreciate it. For those who want to hear more from you, could you talk to us a little bit about the work you do at Kitco and also the Gold Forecast?
Certainly. Every day I produce a article that's been tagged after hours. It's after hours because I'm in Hawaii, and I send it to them by 6:00 p.m. Eastern Standard Time every day. And that's been there every single day, 5 days a week for 12 years. You can read my letter or my column each and every day. We have our premium subscribers and a lot of information on our website, which is thegoldforecast.com, one word, thegoldforecast.com. YouTube is a place that we house all of our videos since 2010. We have over 2,000 videos that anyone can view, and that's YouTube at the Gold Forecast. So those are the primary ways. And then if you want, we have a Twitter handle, and that's just at Gary S. Wagner, S standing for my middle name. And those are the best ways to get more information about what I do and what I'm thinking.
Great. Well, we'll put all of those links in the description below so you guys can check them out. Thank you so much for joining us today. And thank you everyone for tuning in. As a reminder, the next Vancouver Resource Investment Conference is coming up January 21st and 22nd in 2024. So we'll be counting down to that. Gary, it was a pleasure.
The pleasure was mine, and I can't wait to see everybody in Vancouver next year. This last one was just astounding. Jay Martin is an absolute brilliant producer of this show. It's, from what I understand, been going on for many more years than Jay took over, but he does such an exceptional job. He brings some of the smartest minds in the room, and then me, who I don't consider to be one of the smartest minds in the room, together for people to hear the most current and really revealing information on where we're headed, economically speaking.
Absolutely. Well said. Last year was or this year, January was my first VRIC, and it was incredible. So I'll be there, you'll be there. Looking forward to it, and you have yourself a great day.
Thank you very much. As I say, aloha and mahalo.